It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. Thanks so much for spending part of your weekend with us. It's Jill on Money. We are broadcasting live from the Capital One Bank studios here in New York. Ah, boy. Mother's Day weekend. Mark, did you get your cards all sent out? Mm-hmm. Very interesting. Do you have to do mother-in-law card? No, you don't do that. All right. Just checking. Maybe you have to get your intended a soon-to-be Mother's Day card. Parents, have any interesting advice to offer Mark, who will be with a child in the studio as of probably mid to end of June? You think you'll bring him in? You might have to. I think we're going to have to. Mark will bring in his child, and I will bring in my children. We'll see how that goes. No, they're not going to eat. My dogs love kids. They really do. Well, I shouldn't say it. Some kids. Anyway, if you've got a financial question, we would love to hear from you. All you have to do is send an email. Ask Jill at jillonmoney.com. And, we are in the midst of its college graduation season, right? And so that certainly brings to mind things that are going on for families in terms of lending and borrowing and all that stuff. So to talk about that is Barry, who's on the line. He's calling from outside of Philadelphia. Hello, Barry. Welcome to the program. How can I help you out?
Good morning, Jill, and thanks for taking my call.
Of course.
So I put my daughter through college, and all the while through, I wasn't really able to make payments. So the tuition kept compounding, and at the end of 4 years, they consolidated all 4 years' separate loans, plus all the interest, into one $147,000 loan.
That hurts when you say it like as one loan. It probably would feel a little bit less worse to have all those bits and pieces. Okay. And this is this a plus loan, or are these the loans that the kid took out?
So I believe it's a parent plus loan, and it's morphed into a federal loan services loan.
Okay.
And it's in addition to my daughter. She has a loan also, but I'm not going to talk about that right now. Let's just talk about
Let's talk about you.
loan.
Let's talk about you, you great parent, you. Thank God for you. Okay, so there's a $147,000 loan. What's the interest rate on the loan?
Like 7.15.
Yeeks. That's kind of high.
Right.
Okay. So how are you doing managing the payments?
Well, I'm struggling, and this last year's taxes, 2018, that interest was $10,000 for the year that I paid, and I was only able to write off $900 of it. So I don't know why, but that's the way it is, the way it's classified now.
Right.
So I'm trying to figure out how I can get more of a tax deduction on such a large amount of interest. And I thought an additional bonus plan was I could reduce the interest rate with a mortgage.
Okay.
And
so tell me a little bit about right now. Let's just go do a little balance sheet work here. How much is your house worth?
So I have two homes. My primary home is worth $250,000.
And what's the mortgage outstanding on that house?
A home equity loan for $60,000.
Okay. What's the interest rate?
4.25.
And that one is an adjustable rate, meaning as interest rates rise, this gets repriced every year or so?
Yes.
Okay, great. And now, so that's the only thing outstanding on your primary is this home equity line of credit at 4.25%. Second home, what do we got there?
$150,000 value. I own it outright, and it's rented.
Oh, interesting. And when you are looking at your kind of projected plan, it would be to stay in the primary residence, or is there any thought that you would sell the primary, move into the rental, or anything like that?
No plans for that. Just stay as is.
Okay. You have a daughter. Do you also have a spouse?
Yes.
And you guys both work?
Yes.
How much do you guys earn together?
140,000.
Okay. And how old are you guys?
55 and 53.
Okay. And how's the retirement planning stuff going for you guys? Both using retirement accounts?
Yeah. My wife only works part-time, but I have a retirement account that, I can't touch till a certain age or whatever, and that's okay.
How much is in there? Is that like a 401k or is it a pension?
Yeah, it's a 401k, and I also have a pension.
That's good. How much in the 401k would you guess?
Roughly 800,000.
Great. Okay. Terrific. And are you maxing out that retirement contribution? Are you putting in the $19,000 plus the $6,000 extra because you're over the age of 50?
Yes.
Okay, great. So that's good. But on the total income, it's essentially now that you have this big payment for the loan, would you say that your cash flow is good or like what? How would you describe it?
It's not good. I feel like I live paycheck to paycheck and make $140,000
I know it's amazing,
a year.
and
it's
you don't
crazy.
and you don't have a big mortgage, so there's so your big mortgage is the student loan payment.
Yeah.
Yeah, I gotcha. Any safe money, like a little emergency reserve fund that you have cooking?
None. I keep it all invested.
Oh my God! Do you have money outside of retirement that's in an investment account?
Yes.
How much?
100,000.
You shouldn't keep it all invested, but I'll kick your butt about that in a second. And when you look at your monthly expenses, now that you have this loan and it's, do you have an estimate of what that is?
Well, it's my whole paycheck every week.
Okay.
It's,
yeah, I gotcha.
So it's like, let's say 1,500 times 4, so 6,000 a month
Yep.
for some reason.
Okay. All right. So what we need to do is we need to figure out where you go next with this parent loan. Do me a favor, hang on the line because we're going to talk about a few different options, and I want you to think about all of them. They are all somewhat different in the risk-reward category. But when we come back, we're going to talk more with Barry. $147,000 in federal parent loan at 7.1%. It's something else to make $140,000 a year and basically only have a small home equity line of credit, and then all of a sudden have this debt piled up on top of it. I understand why he's feeling like he's living paycheck to paycheck, and even though you're making a good living, you can feel. That's the strange thing. Whenever we do these surveys, you can feel like you're living paycheck to paycheck, and you're making a good living. I get it. So when we get back, we're going to talk more with Barry. In the meantime, during the break, hop on over to JillOnMoney.com. You can read our most recent columns. You can watch some television segments. You can also sign up for our free weekly newsletter. Stand by. We're going to come right back and help Barry out. We'll be right back.
$401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we are trying to help out Barry, who has been such a good parent, he and his wife, that they are absorbing a $147,000 parent loan that they used to help their daughter get through college. Hey, Barry, does she have a job, by the way?
Yes, she has a good job.
Oh, good. Phew. I was going to get really nervous for you if that weren't the case.
Yeah.
Okay, so there's two issues here. One is that this loan interest rate is just too high, right? I mean, we got to give you some relief.
Yeah, I don't feel the federal government's helping us get an education at all by keeping those loan rates so high.
No kidding, right? So couple of choices there. So you could refinance the loan itself as a student loan. And, certainly we have many different organizations. We have CommonBond, we have SoFi. There's banks that'll look at just refinance it as a student loan. The choice that you put out there, which is, hey, maybe I should use my house because you've got equity in your home, right? And you could basically get a mortgage pretty easily and use that. The one issue which is a fine idea, but I want to point out one thing. When you were talking about that when we first got on the line, you said, and then I'd be able to deduct the interest. But you can't do that anymore. There is, since December 17th of 2017, any new mortgage or any loans against your property, the interest is only deductible to the extent that it's used to for the house itself, to acquire or improve an existing structure. So you won't get the better tax benefit, okay? So because that changed with the tax law change, that changed. But that doesn't mean you shouldn't do it, because you have a home equity line of credit on the house right now. You said it's 4.25%. If I look up, kind of where we are with, say, 30-year rates, because I'm only looking at a 30-year rate, not to drive you crazy, frankly, but it's simply to give you a lower payment. If you looked at a 15-year rate, the payment would be a little bit higher, but it kind of probably lines up better with where you're looking at for retirement. So let's say that you got a 15-year rate, okay, and you're paying something around, I guess, a 15-year, depending on where it is, a fixed rate. You could get probably anything as cheap as like low fours, 4 to, let's say, 4.25%, 4.5%. So kind of what you have right now in the HELOC. So what you could do theoretically is you could refinance the student loan and with a portion of the home equity line of credit, and probably be able to do that in one fell swoop and still just have one mortgage payment. Part of this payment would be tax deductible, the $60,000 from the home equity loan. The rest would not be. But you'd still get a lower rate by probably almost 3% at full percentage points. So I think I would totally look into that. The other possibility is that you said you had $100,000 in a non-retirement account. And if we assume that you need about $6,000 a month as an emergency reserve fund, I would say you could take $50,000 of that 100 that you've saved and simply pay down a good chunk of the outstanding student loan debt and refinance the rest. So you could do some combination of this. I don't necessarily think that you should stick with a 7+% loan, but there are other options for you. Using the house as one, you could use the rental property, because in a weird way, the rental property kind of works better when there's a loan against it, because you can deduct the interest fully and everything could potentially kind of work out in your favor, but the rate will be a little bit higher, right? Because the rate will be, for a rental property, will be more than a primary. So which of those options sounds appealing to you?
Well, just getting it to 4% sounds the most appealing.
Yeah.
I was also told by other people, never mortgage your house.
I know.
Student loan. And that same suggestion was keep it at 30, and if you can ever pay extra, do it.
Yeah,
get the principal down.
Yeah, I would. So look, there's two issues here. One is the 30 is going to give you the lowest monthly payment, okay? But you're going to have to eventually pay this thing off. So if you want to try to pay it off faster, you get a 15. I think that that is presuming that I'm looking at your retirement, you're maxing out your retirement, and presuming that the payment goes down enough. And I mean presuming that happens, because I think that it would. If your total payment, the home equity line payment plus the cost of the current student loan, if that drops substantially, you may want to consider a 15. You really may want to.
Yeah, I would rather have a 15.
Yeah. I mean, because it's just like psychologically. I mean, mathematically, I can make it work for you either way. But I think what you might want to do is take a look at refinancing the primary. Maybe use some of the cash from the investment account if you want to kind of buy this down a little bit. But get yourself in a place where no matter what, I got this paid off in 15 years. I can handle it. Our cash flow improves. I think that that's going to be something that's really appealing. The home equity line of credit, who holds that home equity line of credit? Which company?
A credit union.
I would go to the credit union and I would talk to them about a total refi, and see if you can really drive down the cost of that refi, because they all want business right now. This would be a great loan for someone to write because you're a good candidate, right? You make a good living. You got equity in your house. So I would go and shop this around. I'd go to the credit union first. I'd talk to other lenders, and I would see how you could do in this. I think that your payment is going down, okay? Absolutely. I have no doubt about that. But
I have a question.
Yeah.
Do you think anybody would loan me this money without refinancing my house as
Yes.
collateral?
Yeah.
Just give me a loan?
Yeah,
And would
sure.
that loan be like 5%?
I don't know. That I don't know. Because
All right.
when I look at a student loan refinancing, I mean, again, that's where you want to go and sort of you'd have to shop it around. So, there are again, the different the very different companies are CommonBond, SoFi, Citizens Bank. These are places you go look and you can just refinance the student loan itself. And if you're going to do that, I will say this, that's kind of interesting. Then in that case, what I would probably do if I'm going to refinance it anyway, I bet that if you use some of that investment account and you drive down the principal, like if you said, let's just say that instead of $147,000, you say, I'm gonna pay $47,000 down right now, and I want $100,000. They'll probably give you a better rate. You look like a better candidate if you pay some of it down as you start to refinance it. And I think that's where you're going to probably get better rates. So I would try that, and then I would compare it. And then you got to see where this all comes out. I mean, some of these companies, they have, term loans that, yes, they go up to 7%, but maybe you can get 5.5%, and maybe that works well for you. So you really have to shop it around. I think you're a great candidate to do this. I would very much encourage you to look at all these options and get back to us when you have some of the pricing, and we'll be happy to help you out, Barry. So thank you so much for calling. Again, everyone else listening, there's a lot of different companies out there for student loan refinancing, the ones that you may have heard of, and the ones at least that I am, kind of the most familiar with. That's not that I'm endorsing. Are CommonBond, SoFi, Citizens Bank. There are other ones. There's one called Earnest. There's Laurel Road. I don't know anything about this company, but they definitely have low fees. So check it out, Barry. Good luck. And as much as possible, we're going to drive this down. All right, you are listening to Jill on Money. If you've got a financial question like Barry, give us a holler. Ask Jill at jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back with Jill on Money. If you've got a financial question, we would love to hear from you. Just send us an email. Ask Jill at jillonmoney.com. And if you miss any part of the show, or maybe you want to catch up on some old shows, you can go over to the website, jillonmoney.com. You can read, listen, watch some segments. Don't forget, you can sign up for our free weekly newsletter. That's kind of cool, right? Come on. All right. So let's move on, because we have many, many emails to catch up on, right? Okay. So here we go. This is from Regina, who says that she has her first graduating from college this year. Woohoo! and says, I'm looking for a simple first step kind of book or steps for her to start learning how to make her income work best for her. Savings, emergency, debt, anything would be appreciated. Well, I'll tell you what, this is a great question. And I think that for most of us, what you need to know is that anything you can do to kind of get the kids on track. So I think, first of all, you say, all right, what are you going to do to track your money? What is the app that is going to help you keep track of what's coming in and what's going out? That could be a really good first start, right? Next, you want to try to say, what are the goals for this kid? So the goals could be anything from, let's talk about my big three. I want to pay down my debt. Maybe it's student loan. Maybe it's credit card. Maybe it's an auto loan. Pay down the debt. That's really important. Second goal, you want to create an emergency reserve fund. 6 to 12 months of living expenses in the bank, in a money market, in a short-term CD, something safe. Now, and the other thing to remember, by the way, is that these goals don't necessarily have to go 1, 2, 3 in order. These are sort of 3 general goals. The third would be to maximize retirement plan contributions. Now, a lot of kids are going to start off in their first jobs. Maybe they will have access to a 401k or a 403b. If there is a matching component to that actual plan, you want to encourage your kid to put in at least up to the matching component. Let's say there's no plan. Let's say there's no match. Then what? Then it might be, if you had no plan, you open up a Roth IRA for the kid. Maybe he or she does it himself. Maybe you even put in like a parental match if you could afford it. Hey, for every dollar you put in, I'll put in 50 cents. And I think that could be a great way to start. But again, tracking the money doesn't mean you have to be on some hardcore budget, but you just have to know, where is the money going? And then you can figure out, what is my monthly nut, right? That way you can help figure out how quickly you can pay down debt, how much money you need to save for your emergency reserve fund, and what's available for retirement. Now, if you want a good primer book, one book that I like is actually, I just interviewed Erin Lowry, and she wrote a book called The Broke Millennial, which is a good book to try. My friend Jack Otter wrote a really good book called Worth It, Not Worth It. Those are 2 good kind of starter books, and I think you would be well served with either or both of them. So good luck. I hope that works for you. To me, this is like the best gift you can give as a parent, to instill these skills. Okay, this is from Patricia. My husband and I are the parents of 3 kids. Oh my God, all born within 14 months. So twins and then one. Throughout my kids' lives, all have gone through everything together. Teen years, private high school, private colleges, all graduated the same weekend. We were able to pay private high school out of pocket, meaning out of her cash flow. But college bills soon mounted. What really disrupted our finances was the fact that my daughter actually attended 3 schools in 1 year. Oh. And she tells me which schools. And then she says, we missed out on any financial aid for her in the years where she was transferring. The twins got a lot of financial aid. She didn't take on debt, or she and her husband didn't take on debt for them. And so she writes, basically, I knew we had student debt, but I never knew how much until I asked my husband. Long story short, he retired recently, took a package to leave. He was out of work for 3 years before finding another position, and this one doesn't pay a third of what he was making. One of my questions is how any institution would loan out so much money. I didn't know the total dollar amount. My husband told me we have $130,000 in student loans. The, quote, good news is the debt dies with my husband. I'm being sarcastic, she writes. My daughter has loans, about $30,000. Is there any recourse for us? No. Can we negotiate on loans? Yes. Yeah, you can. You can basically try to refinance your loans. You can go to, if they're federal loans, you can go to studentloans.gov. And so federal loans, you can check out the different programs there. The other thing that you can do is, as I said, you could refinance, but again, it's not a renegotiation as much as it's just a different way to characterize it. So I wish you good luck. You may want to also check out CommonBond. We just interviewed the CEO of that company, so there's a place to start. SoFi, they refinance loans. Just be careful and know what you're getting into. It's so important. Really, I can't tell you how these problems are just escalating. $1.57 trillion in outstanding student loan debt through the end of last year. And I'm worried that you didn't know, because that means there may be other things you didn't know about in your financial life. Stephen writes, he's 52. He feels so much stress managing financial issues. He wants to learn more about managing money to help reduce stress. What books or resources do you suggest for a beginner to intermediate investor? My book. Is there another book, Mark? What other book should we tell him? I think that actually my book is, if you're feeling stressed, my book might actually help a lot, because it's the dumb things smart people do with their money. It really is not so much about investing, but it does talk a lot about how come you're so nutty about your money. And that might be helpful to you. So check it out. All right. It is the Jill on Money show. We are partially shrinks and we are partially financial planners, CFPs. Hey, Mark, did you hear back from the CFP board yet? All right. We'll have to talk about that. If you've got a question, send it along. Ask Jill at jillonmoney.com. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. And would love to hear from you. Always like to hear from you. Ask Jill at jillonmoney.com. Love to know how things are going as you navigate your post-tax springtime. What's going on? Got plans? Summer plans? I just got one of those nutty research things that says, once again, Americans just don't take the vacation they're allotted, even when you get paid to take vacation. I don't know what's wrong with us. Take your vacation, guys. You know what some people say is the reason they don't take it is they feel like, God forbid I take it, something goes on at work, and then they see I'm not needed. Well, let me tell you something, gang. If that's when they realize you're not needed, you better be kicking it up a gear while you're there. Okay? All right, let's do some emails. John writes, I want to thank you in advance for taking the time and read my question. I spoke to you last year about my 401k contributions, and I've got a new question for you today. What do I do with excess money after maxing out allowed contributions to a 401k and an existing Roth IRA? My first thought is to just add it to a brokerage account, treat it like any other money in there. But I keep hearing about backdoor Roth conversions, which makes me think those should be used to take advantage of the tax-free growth. We get a lot of questions about backdoor Roths. And the way they work is essentially that some people cannot put money into a Roth IRA because they make too much money. And so what we tell them to do is you can make a contribution to a non-deductible IRA, right? Non-deductible, so no deduction, and then quickly convert it. However, in this particular case, John, you're already putting money into a Roth, so you can't do it twice. You can't basically have two chunks of money, one going into a Roth, one going into a non-deductible IRA. So I don't think that's the case, that that's not going to be good for you. So you can't do $6,000 and then $6,000. So the answer to your question is exactly what you say, which is given the numbers that you have, that you really have, if you've got $10,000 to invest, maybe just say $800 a month is going into my investment account, my regular old brokerage account, pay the tax on it and move on. That's it. But you can't do the double IRA contribution, even if one is Roth and one is non-deductible. Okay? Linda says that she has to move out of her family's house by the end of 2019 and says that she wants to go back to the Bay Area and knows that she wants to go back to the Bay Area, but should she rent or just go ahead and invest in a small condo and have a place to live? This is a person who has tons of student loans. She had already called in, checked in with us. I know you want to have a house. I know you do. I don't know how to make this any more blunt. And that is, if you've got piles and piles of debt, I don't get why people are so apoplectic about making sure that they own something when they've got piles of debt outstanding. I don't get that. It's not necessarily in your best interest. I mean, look, if you lived in a cheap place, you're going back to the Bay Area. Are you kidding me? Like, you can't afford there. You're barely going to be able to rent there. Pay down the debt. Come on. David writes that his wife started a new job and they have an opportunity to open an HSA account. I've heard so many great things about the account. What's your opinion? She's currently enrolled under his health plan. He works at a big HMO. Huh, how interesting. And so he says, I cover for her and the family. If she signs up for the HSA at her new place, does this mean she will not be under my medical plan? Yeah, that is exactly what it means. And so she'll be on a plan which is a high deductible plan, and it's paired with an HSA. And I think that I'd have to know more about like what your plan covers. Because if you have a great plan, it may not be worth it for her to do the HSA. I love the HSA also. It's a great way to save. But I would need to know, like, if you have a kick-butt health plan because you work for an HMO, maybe you'd have to forego the HSA. I don't know. I'd really have to look at that and see. Okay. Kimberly wants advice regarding financial advisor and products that are being recommended. She says, I'm an adult-only child. This was, and someone recommended an Index Universal Life, which Kimberly purchased last August. She was planning for both herself and the care of her parents in the future. She was planning to leave her job. However, life happened in January. My biological dad died unexpectedly, and I didn't know about what to do. There's all this different stuff. And now, what's the deal? I need a fiduciary in the Washington, D.C. area. So, you know what, Mark, besides going to NAPFA, NAPFA.org, which is the fee-only financial planners out there, what about Margaret Chang? Wasn't she on the show? And she's in the D.C. area. Let's hook Kimberly up to Margaret, who's really smart. So I would try that. Man, I'm blowing through this stuff. I'm exhausted. Okay, if you've got a financial question, don't you get tired. Go to our website right now and sign up for our free weekly newsletter. And since you got something for free, maybe spend a few shekels. Why don't you go out and buy the book? Click on the link, the book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. Okay, we will be right back. You're back with Jill on Money. If you've got a financial question, an education question, a tax question, shoot us an email. Ask Jill at jillonmoney.com. John writes he enjoys listening to me on the radio, and he says, I feel like I learn something new each time I listen. Fantastic. Okay, so John's 33 years old. He makes somewhere between 90 and 130 grand a year, depending on overtime. No kids, looking to retire at 55 to 60 years old. What's with these early retirements? I don't know. I don't get it. I don't know. Work till they got to yank me out of this building. But okay, here's the deal. Here's why. He says, I want to enjoy my last years because I have a permanent medical condition that indefinitely lowers my life expectancy. All right, that's a valid issue. He's got a year's salary in a high-yield savings account. He's got a Roth 401k, puts 20% in it with an employer match of 6%, and a special employer match, another 8%, an external Roth IRA he maxes out each year, and a trading account with some of his Motley Fool stock recs, yielding about 30% yearly gain. Wow. No debt. Haven't purchased a house. He's got a pension plan. So with what I currently have and invest in, are there any other opportunities I should be looking at? And if I'm getting a better return from my personal portfolio than my 401k, should I back my 20% down and use the additional take-home money to invest in my personal portfolio? What do you think my answer is going to be to that, Mark? What, thumbs up or thumbs down? What do you want to do with that? Down. He gave me a double thumbs down. That's exactly what I think. That personal portfolio should be like your gambling money. That should be your fun money. No, I don't think you should back off on it. I do think that when you describe your situation, I know that you have a year's salary in a high-yield savings account, but what you need to be thinking about is because you do have this medical condition, I would maybe want to put actually right before you retire, I would want you to put probably 2 years away. I know that sounds like a lot, but it probably is. It probably is in your best interest to do that. All right. Hey, that's it. That's hour one. So fast it went by. We are broadcasting live from the Capital One Bank studios here in New York. And during the break, why don't you hop onto our website, JillOnMoney.com, and you can subscribe to our podcast, our sister podcast, Apple, Stitcher, Radio.com, Google Play, anywhere else you find your favorite podcasts. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
All righty, it's hour number 2 of the Jill on Money show. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. So go check it out at policygenius.com. And so here we are. It is approaching a graduation season for you college graduates and the parents and family members of your college graduates. And a whole bunch of you are going to see that now, oh boy, here comes the student loan situation. You know, we've had our guest on the show previously, but I now want to come back to our friend Kelly Peeler, who is the founder and CEO of money-mentor.com. That was formerly NextGen Vest. And money-mentor.com is now a division of the education lender CommonBond. And Kelly's boss is going to be joining us later in the program. But to get us started, I really wanted Kelly to come on and talk to us about the service that Money Mentor really is. It is essentially providing high school and college students with help they need to navigate the financial aid, scholarship, and student loan process by connecting them with what she calls money mentors. And they use text messaging because, hey, the kids text. They don't do it the way the old folks do, like us. So we are going to talk to Kelly. Again, if you need some help on this, we will have a link to an article I wrote about it. But right now, let's get right into our interview with Kelly Peeler.
Money mentors are trained college students, so they themselves have had loans. They've probably done work study, and they were looking for a way to both help other students get trained. So they're probably interested in going to financial services and make some money on the side. And so we train money mentors. We put them through a whole training program. And what they do is they talk and coach students anywhere from 17 years old to kind of freshman, sophomore in college through the whole process. So anything from finding scholarships, filling out the FAFSA, negotiating their college tuition, understanding their financial aid packages, picking the cheapest meal plan, and really kind of in a way that's relatable to an 18-year-old kid. Our whole platform is over text message, so you can get help at 11 p.m. on a Sunday from someone who's kind of like you and who's been there before.
Interesting that you have younger people talking to younger people. Was that part of the thesis here that you know, an old fart like me saying like, sound, it's better coming from someone who's closer in age?
Totally. I mean, this Gen Z or the next wave of millennials. So these are the people who are spending 2 hours a day on Snapchat.
Okay, and how old are they right now? Those Gen Z?
Anywhere from they're teenagers. So
Okay.
teenagers and into college right now.
Okay.
They just totally talk different than you or I. I'm a millennial, so even different than I am. I'm
First
a
of
little
all,
bit
Kelly,
old.
I basically feel like I could be your mother. So let's just call it I'm your cool Aunt Jill. Okay, that's
Done.
what we'll do because you got that mother. But so those kids, they communicate differently.
Yeah.
They love text.
They love text. They love memes. They like emojis. They like GIFs. They like putting filters on everything. And so money, and especially student loans, is this really, really stressful time period for an 18-year-old. I mean, they're basically buying a house, right? They're signing up to buy a house, $200,000 to go to college. And they're doing it with not a ton of guidance. They're doing it where their source of truth is potentially their parents who the cost of college was totally different for parents, so they're not really totally knowledgeable of how this goes. Maybe their college counselor who is trying to help 500 other kids, or trying to Google and read crappy blogs.
Right.
And so what we found, kind of our key insight is that stressful money topics have to be discussed or made more transparent by someone who you trust. And that happens to be for our user, which are, an 18, 19-year-old kid, someone who's already been there, someone who's gone through the process and who has been trained, who can also talk to you in a relatable way.
And using a money mentor was a free service, right?
Yep.
Just explain this before we get into like what your next phase has been, because that was free. How can you provide such a service for free, or how were you able to?
The short answer is that our broader vision was to really think about how do we redesign the whole process of student loans. So whether that was making our own loans at some time, maybe that was introducing a subscription service, but we found a partner in CommonBond that we really aligned with our broader mission and vision, who acquired us, which was really exciting for our team so that we could continue to offer the service for free and not be pressured to do anything that would be against the actual interest of our end user.
And is it moneymentor.com or?
Yep, it's money-mentor.com.
Money-mentor.com.
Yep.
Okay, and so how have people stumbled upon you? Do you go and talk to guidance counselors, or how do you get the word out besides us?
Yeah, we do. Yes, we go into high schools and do workshops for free. If you're a parent or a student at 1,000-person high school, we will come in and help your college counselor. We'll host FAFSA nights. We'll host how to negotiate your tuition nights, and then we'll sign people up for money mentors if they want additional help.
So a few weeks ago, I did a segment about college and student loans, and we found this woman who had graduated undergrad with pretty reasonable debt, maybe say $10,000. Okay.
Yeah.
But it was she was very interested in art history. She really wanted to be like a museum curator.
Yeah.
She then went to grad school. It
Okay.
all went
Sorry,
down.
I should know that reaction.
Yeah, I know. It's like it all went downhill from there. Anyway, she ends up with a wonderful master's from a nice school and about, let's say, $60,000 in debt. When she got out of that program, she could get a job that actually paid $11 an hour.
Wow.
Okay, so
Which I'm also not surprised.
I
by
know,
that.
right? It's so hard.
Yeah.
So now she gets out of school. She takes her $11 job. She's living in New York, trying to, like, great arts community.
Right. Yeah.
It was bad.
Yeah.
So anyway, long story short is that flash forward, she ends up with paying $20-something thousand down on this debt and still has an outstanding loan balance now of $65,000 or $67,000. She went back and got a certificate in coding, moved back to North Carolina, got a great job,
There you go.
and tackling the debt.
Good for her.
Okay, so now we come out, we've done the segment, and I given my advice. And so I said, well, obviously we would like to have different conversations before she assumed that debt. It'd be great if she could have figured out that there are actually no jobs in that industry and that they pay really crappy and that all this stuff, right? And then we were talking about broader advice, and I talked about negotiating with schools.
Right.
I got a very interesting email from someone who said, stop perpetuating the myth. She says, I work in college admissions.
Yeah.
And she said, and we don't negotiate ever. And I said, that may be. And so I wrote her back very nasty. Maybe true at your school.
Yep.
I know countless instances of negotiating.
Yeah.
Can you back me up on that?
100%. We help students in the past year and a half negotiate over $300,000 in tuition costs.
Sometimes it is.
Which doesn't apply to every college, for sure.
Right, of course. But like there are some times where you say, hey, I got this offer from this college, and they're giving me a $25,000 a year free money, right? A grant. And we'll talk about that.
Or a merit scholarship.
Or scholarship, right?
Yep.
Can you do something?
Yep.
And sometimes they say no. But as you said, sometimes they say yes.
Just like asking for, a raise in your salary. Sometimes your boss says no, but it's worth asking.
Okay, we are going to talk more about college financial aid, scholarships, grants, all of it coming up next. It's Jill on Money. If you've got a financial question, send us an email. Ask Jill at jillonmoney.com. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You are back. It's Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill at jillonmoney.com. We are in college graduation season. And also, by the way, a lot of kids going now that there maybe summer breaks are coming up. You're going to go on your big tours. I was going to say financial tours, but it is a financial tour of colleges. As you do that, it may be worth having real serious conversations as families about what you can actually afford. If you think this is hard, wait until you see what it's like to try to untangle what various college reward packages look like. That's why we turn to our guest, Kelly Peeler. She is the founder and CEO of Money-Mentor.com, a division of CommonBond. And we're going to talk about how you go through these letters. So here's more of our interview with Kelly Peeler. So one of the reasons that I wanted to bring you in is that when I saw you recently, because I was on the CommonBond campus. I like calling it a campus. It makes it sound bigger. All right, office. I was in the CommonBond office hawking my book is what I was really doing. Kelly was nice enough to sort of say, hey, come talk about your book at our company. And as I was there, you put in front of me 3 different letters from 3 different institutions to the same person, right?
Yes.
Okay. What you were showing me was how different award letters can look. All right, so let's go through this.
And let's just say what an award letter is.
Okay,
so
go.
Even that is a little bit misleading. So when you get into college, yay, celebration, I got in. Then you get your financial aid package. So that's basically your bill. However, colleges deem this as your financial aid award letter, which sounds like you're getting a prize. But it's basically your bill. It's a breakdown of the cost of tuition and then also like what you might get with scholarships, grants, and different loans, which are somehow bucketed in there and sometimes subtracted from the total cost. But it is what we're looking at is one student's options or bills to go to 3 different colleges, and they're called financial aid award letters.
All right, so I'm just going to let's just pick this one. We won't say what university it is. All right, so now we're looking at, let's call it What's the Matter You? And here at the top, tuition and fees, $38,868. Room and board, $15,000, total $54,000. And then, of course, by the way, they say indirect costs not reflected on bill, books and supplies, transportation, miscellaneous.
Miscellaneous of $600.
And by the way, this is such a low number, it's ridiculous.
Yep.
It is. There's no way that that's the number.
Right.
Okay, so now let's go down, and now we have the total estimated cost of attendance, both direct and indirect. They say it's $56,000, and it says your financial aid package is based on this figure.
Yep.
Here is the financial aid award package. And there are 2 semesters. There's fall, there's spring.
Which, let me just point out, this is only for 1 year. So most students go to college for 4, call it 5 years on average. They might do an extra year, right? So you're only getting a bill for 1 year. And the reason why I say that's important is because the cost of higher education has consistently gone up. Tuition prices have consistently gone up every year for the past 30 years. So it's really hard to plan ahead and make a decision if you're only seeing the cost for 1 year.
Okay. So there's a lot of stuff in here, right? We have the Dean Scholarship.
Yep.
Which I guess, is a scholarship mean that you get it, that's your money, and it's not taxable, and that's that?
Yes.
A
so
plain
that
old scholarship.
It's plain old scholarship. You don't owe it back.
And then you get another thing that's an award, which is also
Don't have to pay it back.
don't have to pay it back.
Yep.
Then there's a space, and it doesn't say anything else here, just a space. Subsidized Stafford loan, $1,750. Unsubsidized Stafford loan, $1,000. Federal work study, $1,000. And then federal parent plus loan. And then you look down, and if you don't read this carefully and we don't decipher all of this, we see $28,291 is what you think you're getting.
Yep.
So
that's that's like the total line.
That's the total line for this semester. And then the same for the second semester. And there's the total, which miraculously is $56,000. Okay, so
Cheap, right?
cheap. But what's interesting is when you look at that, when you look at this first glance, what's happening is 11, 12, 13, 14. So there's basically 15, about half of what they say is your award per semester
Yep.
is, in fact, a loan.
Yep.
And the other half is, in fact, a scholarship.
Yep.
All right. So now, half of this scholarship, half of this is loan. So a couple things that pop out for me. That's not clear. It is
Absolutely not.
It's true that it is. It says loan, work study, and then loan,
But there's no interest rates there.
and there's no
either.
term.
Right.
And there doesn't say. There's nothing that says, hey, if this is going to be paid back in 10 years, this is what your monthly amount
Yeah.
will be when you graduate,
Right.
right? All that we have at the loan eligibility, and they have like little loan stuff here with nothing. I accept and I reject.
Right. So you literally click a button that's like accept without knowing interest rate, without knowing monthly payment afterwards, without really knowing the terms.
I find this mind-blowing. Why?
This is what I'm trying to tell you,
I
Jill.
know. So one of the things you pointed out to me when we first met a few years ago, maybe longer than that, but it's been a while.
Years, yeah.
We've known each other, was that there was no standard format
Yes.
for reporting this. Why not?
Just because it's not mandated by the Department of Education. So every college has their own little financial, or not little, sometimes massive financial aid office, and they determine how they want to communicate with students about their own financial aid process. So all the letters aren't even sent out on the same day. So what happens a lot of times is that parents, if you have divorced parents, one parent might get one letter, another parent might get another letter. You put them under their bed, you lose the letters, you don't know where all these things are. They're in different formats. So kind of long story short, this is a very confusing and opaque process.
So what should this kid do right now?
Yeah, great question. So what we've actually introduced to help a student solve this problem is the first major problem, which is let's actually compare your options apples to apples. So right now you're looking at like apples, oranges, tomatoes. You're looking at different ways of evaluating each different opportunity that you might have. And so what we do is a student can text us these award letters, and we will put them in an apples to apples comparison so that they actually see, okay, for across all of my colleges, how much am I taking out in total loans? How much am I getting in total scholarships? What will be my work study across all of them? So we lay it out really clearly so that they can say, literally, what do I have to pay and what do I have to owe?
Let's bring in David Klein now. David.
Hello.
The tardy David.
Yes.
Welcome to the broadcast center here in CBS. You must live in some far away place. You just look so MTA'd.
It's this
You
far
just
out,
got MTA'd.
It's this far out borough called Brooklyn.
This is why I don't go to that borough. That's exactly why I don't go there. So now Kelly has identified this great program that is essentially helping kids with these decisions today. And David, you are the CEO of CommonBond, which acquired Kelly's company. First of all, what is your background? Why did you get into this? Let's talk about what's the mission of CommonBond? Why the hell did you get into this business?
Sure. So the mission of CommonBond is to lower the cost of higher education in the U.S. And the reason I got into the business is very personal. I went back to business school. I had to pay my way 100% with student loans. And my options at the time really stunk. The rates were unnecessarily high. To Kelly's point, the process was complex. As well as to Kelly's point, the service was really poor. My ability to just understand my options to pay for school were very limited. And I pretty much had to create that system for myself. And I realized other people were just like that. And I thought, there's got to be a better way. And I went back to business school with the express purpose of starting a company and running it before graduating. I come from a family of entrepreneurs. I always knew that's what I wanted to do. And so there was this perfect storm of the personal pain point needing to borrow to go to school, and it was a stinky process.
What do you mean? What, these entrepreneurial family members of yours couldn't afford your education, or they wanted you to sink or swim on your own?
I got some loans in undergrad, but they were clear they would help out during undergrad, and that for grad school, I'd be on my own. I feel in retrospect blessed that was the case. Had it not been the case, I wouldn't have felt the pain associated with student debt in the U.S.
Okay, we will get back to our interview with Kelly Peeler and David Klein in just a minute. During the break, why don't you head over to the website, JillOnMoney.com, and there you can buy The Dumb Things Smart People Do With Their Money, 13 ways to right your financial wrongs. Yes, there is a big chapter about college and college funding. Okay, so go buy the book, and then when we come back, more with Kelly and David.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. Hey, do you know that there is a segment of student loan borrowers that is growing faster than any other segment? Do you want to know who that includes? How about Americans who are 60 years old or even older than that? A lot of these folks took out loans to help pay for their children's college tuition, maybe their own college tuition. If they went back, they're still paying them off. Student loan borrowers in their 60s owed almost $34,000 at the end of 2017, up 44% from 2010. So in 7 years, holy smokes. So if you're wondering whether or not you should refinance that student loan debt, well, we've got the perfect guest for you. It's David Klein from CommonBond. He's here with Kelly Peeler. David's company bought Kelly's company last year. So here's more of our interview with Kelly and David. All right. So, David, there is $1.5 trillion of student loan debt. And if I go to CommonBond, hold on, I have it right here on my handy dandy computer. You have a lot of different loans and opportunities to refinance. Mm-hmm. So let's talk about the refinancing first. Mm-hmm. A lot of people will ask me, I just spoke to somebody about this, and they said, I have $55,000 in outstanding student loan debt. It's 5.25%. Over the last year, I've made the little bit more than the minimum payment, and my outstanding balance went up by $1,000. So it seems to me that we're doing a pretty bad job explaining to people how to pay down loans. How does CommonBond approach the refinancing process?
Sure. What we do is we say, hey, most of you have a federal government loan. That federal government loan comes with effectively one interest rate, no matter your credit, no matter your future prospects. And so it's a highly inefficient pricing scheme. And so what we do is we take a look at every individual borrower. We collect all of their data, we underwrite past credit, future prospects, and then we provide a lower rate for those who are eligible. And so when we provide that lower rate, we're saving people many times hundreds of dollars every month, thousands, tens of thousands over time.
David, when you look at this $1.5 trillion, in a perfect world, what would happen with the federal student loan program to make it operate more feasibly, like in a healthy way?
That is probably a more complex question than you might fully appreciate. When I hear that question, I think it has to do with, one, just the structural elements of student loan program in the United States right now. The fact that the federal government represents over 90% of all student debt. A lot of the pipes underneath the surface, a lot of the technology underneath the surface, and the servicing underneath the program is all farmed out to a bunch of vendors who don't exactly have the best history of putting a customer's interest first. To be fair to them as well, they're working within a context, an operating sphere that is highly constrained. And so that's where you get a lot of these headline issues of customers not being treated right. It's because fundamentally, structurally speaking, the system is in fact broken. And so the question then becomes, okay, well, what do you do about it? I think there are a few different constituents that really matter here. One remains the federal government. One is the private sector. Private sector in two forms. One, private sector to offer better products and services. And two, private sector employers of many people in this country who have student debt. There's something for both to do. And then the borrower themselves.
Kelly, the fastest growing segment of student loan borrowers are over the age of 60.
Mm-hmm.
So I know they don't have the total, the raw dollars aren't as big, but they are the fastest growing. Talk a little bit about these plus loans. How should families be approaching this?
Yeah, so Parent Plus loans are for parents on behalf of their student, and you have to have a good credit score. So
or at least a decent one.
A decent credit score. And obviously that kind of changes over time. But yeah, it's more if you think about loans in terms of expensive or being expensive, it's more expensive than the subsidized and unsubsidized loans.
David, do you actually allow for the refinancing of parent loans as well?
We do. Yeah.
And do you find that that's a big need? I mean, you've got a lot. I guess you have a lot of competition for that because parents have more access to the credit markets.
They do, technically speaking. Not many people, though, understand that they can refinance their Parent Plus loans, whose interest rates are insanely high.
So when we look at what's happening now, are you feeling good about this?
If I think about it from the consumer's perspective, both at a macro level and a micro level, I'll start micro first, very personal. We know that more people are taking on more student debt. What we also know is that that is starting to impact individuals' ability or willingness to do things like take out a mortgage and buy a house or buy a car. And so to the extent this student debt train isn't kind of taken control of in some capacity, this will likely continue to put stress on people on a micro level, as well as continue to put stress on the economy at a macro level. It goes back to your other question around what can we do about this. One of the things that I addressed in my answer had to do with the financing cost of education. But the base of everything is the actual cost of education. And if you look at tuition increases and you compare that to normal inflation, it's very different. And even when you compare it to inflation in things like healthcare, it's right up there, and in some years is actually growing faster than healthcare costs.
And of course, you know that all these colleges could lower the cost of tuition immediately, just admit more people, or like start your online division and let's move on. Like, why are we letting this whole thing get out of control?
So I think part of what's happening is that you have some colleges and universities that charge a lot, and the data will say it's actually worth it. But then you have another set of colleges and universities that charge a lot, and the data says it's not worth it. Mm-hmm. And so I think everybody can agree that no one individual should be saddled with more debt than their life will allow them to pay back. And so the question is, how do you prevent that from happening? And I think there are a few interesting things that we can do. It's still in conversational stages right now. It leads to some pretty tough choices that people, including politicians, are going to have to make around, given the number of colleges and universities we have in this country, is it okay if we have less overtime? Because if we go to a world where the school is held a little bit more accountable to how many people they not only graduate but get employed, and are therefore responsible for some of the delinquencies and defaults that happen from their students when they're not getting employed, that likely leads to a world in which some colleges and universities shut down. That also leads to a world in which maybe the number of people that are going to a four-year college today shouldn't be as high.
Thanks so much to Kelly Peeler of money-mentor.com and David Klein of CommonBond. Go check out the websites. We'll have links to everything, and pay attention to that student loan debt. We're going to help you through that. And if you've got a financial question, give us a shout. Ask Jill at jillonmoney.com. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money. If you've got a financial question, the email address is askjill at jillonmoney.com. Hey, you know what's interesting? I was researching some stuff for college financial aid season, and I just found out that there are almost 20 states that are offering student loan repayment to recent graduates who are in high demand fields in those states. That's kind of cool. Mark, did you know about that? I didn't know about that at all until I started looking into this. And it's really interesting. So this is a way to basically say they've been these plans mostly adopted in the last 5 years or so. Debt forgiveness as a perk of relocating. Many specifically tie loan payments. I'm reading from a Wall Street Journal article that I found about this. Many specifically tie loan payments to a given profession aiming to address workforce shortages in fields ranging from nursing to teaching. Check this out. Utah. That's got to be a nice place to live. It forgives 25% of a college graduate student loans for each year the graduate remains in state and works in a field where the state faces a workforce shortage. Texas offers loan forgiveness to psychologists or other mental health professionals. Maryland helps local farmers pay down their loans. Delaware covers loans up to $10,000 to residents teaching in high-need areas. I love this idea. I think it's so smart. God, it's a lot of stuff going on. It's going to be really interesting to see how not just states but also employers start pushing out these programs. I think this is really going to be a burgeoning effort of financial wellness, especially if the labor market remains tight. So good. It's really good stuff. Okay. Next up. Here's something. Mark, thanks for sending me those 2 things that I've already done. But I did these 2 already. But I have another one in my back pocket here. This is a follow-up from Greg, who had asked us about buying extra insurance. His term life insurance is coming to an end. He's got a bunch of money saved already, and he had 529 plans that would cover about a half to 2/3 of his kids' undergraduate tuition. So I asked him, could you buy? He's self-employed, and I said, can your wife buy additional life insurance through her employer? And he says, yeah, I just checked. Here's what we learned. Yeah, she can purchase, but it's $100,000. The premium is $430 a year for a 10-year term policy. Yeah. And then I said, well, why don't you go check out Policy Genius? What can you get for a 10-year, $500,000 policy? And he says it looks like the cost would be about $1,100 per year. So I don't really think you need in, like, I would say caps and italicized. I don't think you need this insurance. However, if it's going to make your wife feel much more comfortable and it's going to give her peace of mind, if you can buy peace of mind for $1,100 a year, I'm all over that. I really am. I think that would be, I think that is something that's really worth considering. That's what so I would probably do that. All right. Jean writes, I'm 76. I've got 2 annuities. They total approximately $80,000. I also have 2 pensions and Social Security. All of this supports me comfortably, so I don't draw money from the annuities. Would there be a better way I could invest my money? Okay. So I don't know what kind of annuities they are. Are these fixed annuities or variable annuities? That's the first thing. Number 2, are these annuities past the surrender period? In other words, if you got rid of the annuities, would you actually have to pay some fee to get out? And I guess most importantly is, does it really make sense for you to switch things up if doing so would create a tax liability for you? So I'd have to know a little bit more about what these annuities are all about and maybe try to really get yourself a little bit more of a feel for what the other options are. Okay. That's it, man. I'm blowing through these emails like crazy. Mark, where are we? What month are we in? Well, we're getting through. We're trying to wrap up first quarter emails before the end of the second quarter. But, I'm not going to do this. We got so many guests that we've interviewed, and we're going to start putting those shows out on the air because I think you guys are going to like the guests, and you're probably sick of my voice because I know I am. So if you have email questions, don't worry. I will still answer them, but it might take a little bit longer as we come into the second half of the year. All right? So that said, send us a note. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. And if you can't find the information that you are seeking out there on the old interweb, hop onto our website, JillOnMoney.com. You know, we've got a cool little resource section. We have things that are there for you, the websites that we mention all the time. Maybe you want to go look at Money as You Grow, which is totally cool. Maybe you want to look at Beth Kobliner's We Need to Talk College. Maybe you want to look at moneymentor.com. All these things are right there in our resource tab. Just go to JillOnMoney.com. Okay, we will be right back. You're back with Jill on Money. If you've got a question, and that question really could be anything. It can be a retirement question, a college funding question. Maybe you've got a real estate question. Any of those, be delighted to chat with you. All you have to do is to send us an email. The email address, askjill at jillonmoney.com. Isn't that easy? That is what Steve did. Steve writes, "Hi, Jill, great book." I just have to say that. See, this is when I wish I had you on the air with me, Steve, so you could say that. If you don't know, if you haven't heard me hump it enough, the book is called The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. If you would like to purchase it, just go to JillOnMoney.com, click on the book, and there are lots of different places where you can buy it. Or you can hop into your favorite bookstore and probably find it there. Okay, let's get back to Steve. Steve says, "I need your opinion about this investment. The investment is Bright House Shield Level Select 6-year annuity." So he says there are no fees with guaranteed shield up to a 10% drop in the market, no loss until it drops below 10, and a guaranteed 8.5% return if the S&P 500 is positive between 0 and 8.5%. Then your upside is capped at 10%. I'm looking at investing a quarter of my retirement 401k in this. I know this is so annoying because I feel like I want more information. So there's a part of me that's like, well, maybe this is a good deal. You know, maybe if I dig into this thing and you take some of your money, that it could be good. I don't think that this is no fees. Only because I just don't think that, how would Bright House be able to afford to give you no fees? Maybe it is, maybe it's not. I don't know. But I need more information, like what else is going on in your life? And are you already retired? And do we really want to tie up a quarter of this portfolio in a hard-to-liquidate annuity? All right. Send me more information, Steve. Hey, thanks for listening. We broadcast live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. So thanks again to Mark. Thanks to you for listening. We'll see you next week.